Hello, I'm Bill Moorehouse, the Vice President of Sales and Marketing at IT Convergence, and in this video we'll be presenting a model to help project the future productivity gains associated with an accounting shared service center. This video is not being produced in isolation. If you go to our website, itconvergence.com, you'll find that we're having a series of webcasts about shared service centers, and there are other videos, blogs, and resources at our website on this topic. In order to explore the potential value of a shared service center, we're going to look at one type of business transaction and accounts payable, try to project what productivity gains we can achieve when we move from a fragmented transaction processing model to a consolidated shared service center model, and then discuss a few other relevant considerations. In the next few slides, we're going to discuss why you might go through an exercise of trying to project productivity gains for this type of project, how we're going to build up the model, and what the model does and does not do. So IT Convergence has been working for years with US-based multinationals on large transformational global initiatives, including shared service center projects. And we consistently see our customers put together some type of value proposition to present to their management to justify the project. So this model is a tool that we hope will be useful to our customers and others when trying to put together the business case. And we also hope that it's not a one-time event, that you keep coming back to it through the project and after go live to see if you actually achieve the value you projected, and if not, to try to identify what are the bottlenecks that are preventing you from getting the full value of the project. I think you'll find this model very useful for thinking about the different drivers of value, but it's certainly not a full-blown analysis of your business processes. So if you're looking for help with that type of project and something more akin to a global design or a regional design, please contact IT Convergence's Professional Services Group. Now, if you've done research on the web, I'm sure you'll see that many companies expect to get gains of something like 30 to 50% in productivity or total cost savings in their shared service centers by consolidating business transactions. And there are a lot of different drivers for that cost savings. Now, what we will be looking at during this model is the value you can get out of standardizing business processes and investing in tools and technology to help automate the business processes. We're not going to dive into the cost differentials between different labor markets or how to consistently squeeze more value out of the system with a center of excellence in this presentation. So the way we're going to approach this model is starting with an accounts payable process, as I mentioned before, and we'll look at the different timings in that process and how that translates to what we call resource consumption within the model. So essentially the number of people, FTEs, that are used up to satisfy the transaction processing volume over the course of a year. We'll then look at a future state where in the shared service center we've got some different drivers of productivity gains, and we'll investigate how by speeding up the transaction processing we can have fewer FTEs doing the same amount of work. So after we go through building up the model and seeing what we can learn from that exercise, we'll go back to some real-world considerations. So should we really be doing a global design or regional design to come up with a set of standard business processes that we're using across the whole geographic region or set of business units? And what transactions are really going to be in the shared service center, or which ones would be addressed by a local team or a specialized team external to the shared service center? In this section, we'll look at the baseline accounts payable process. For the model, we'll be looking at a global company that processes thousands and thousands of AP invoices per year. And we're going to look at two different variations on the AP invoices. One for regular suppliers that the company works with all the time, very predictable vendor relationship. And the other will be temporary suppliers. Maybe it's something that was project-based or some other type of short-term need. Some of the governing assumptions for the model are that currently each office that exists runs its own AP invoices, and they do not have a consolidated AP or finance system, so they may use their own local system or no system at all, just tracking it in Excel, etc. And the other sort of main set of assumptions is that after the shared service center project, they're transacting on one unified global platform. Then there's some simplifying assumptions. We'll assume that the accounting staff really only do one type of transaction, AP invoices, which is of course unrealistic, but it helps us to formulate the model. And as mentioned earlier, we are going to ignore the cost of labor in different locations, and we will not look at local business process variations. So in reality, not only will we have heterogeneous systems in the different locations, we would have variations on the business processes as well that we'd have to account for. But again, this is a model, so it's simplified. Okay, so this is the basic data about the accounts payable invoices processed by our company that is under consideration. So there's some different columns, the number of invoices that are processed per week by location, and then that is annualized. And then after that, we look at the percentage of the invoices by location that are from the temporary suppliers as opposed to the standard vendors, and we project out how many of those temporary supplier invoices are processed per year by location. Here we have the steps in the AP process, and we will later assign timings to these. So the first step is that an invoice is received, and if the vendor does not currently exist in the system, the AP analyst will put them in. After they're in the system, the invoice will be entered, and the AP analyst will check the supplier payment terms, essentially all of the details of the invoice to make sure that they look correct. If there are issues, then they will chase those down. Once those are resolved, the invoice will be added to a batch for processing. And then as an internal business process, this company requires management review of invoices based on a set of business rules, size of the invoice, specific vendors, things like that. And after it goes through review, the analyst is able to process payment out to the vendor. Now we're going to start looking at the timings associated with the different steps of processing an AP invoice at this company, and later these timings will help us to build up the required staff level needed to handle the volume of transactions. So for standard suppliers and temporary suppliers, the first step is to check if the vendor exists in the system and add them if they don't already exist. And for standard suppliers, 95% of the time they already exist in the system, while for the temporary suppliers, only 70% of the time they exist in the system. So we can see that this leads to a different amount of time consumed for these types of vendors. The next step in the process is to key the details of the invoice into the accounting system, which happens for all types of invoices and takes the same amount of time for every invoice. After the invoice is entered into the system, the accounts payable analyst goes to the procurement system to check the various details of the invoice and make sure that the invoice conforms to the terms of the PO. In the last step, we checked whether there were any issues when comparing the details of the AP invoice against the original purchase order, and in this step, we'll address the issues. So similar to what we did with new vendor setup, we'll use percentages, basically probabilities, to address whether or not any time is spent on this step. And within the yes, there is an issue percentage, we'll also use probabilities to address how complex the problem was to resolve. So a quick fix may take only 2 minutes, whereas if you have to reach out to the supplier to chase down the issue, it could take 20 minutes. And of course, that's multiplied by the various probabilities to come up with the time spent on this step for standard suppliers and for temporary suppliers. Once we've addressed any issues, then we will assign the invoice to an invoice batch for processing. So this company's business rules require some management review of invoices. We don't get into the criteria in the model, but we can assume they're based on things like the size of the invoice, specific vendors that management wants to scrutinize, and we use the same approach of probabilities and complexity to look at how much time is consumed on this management review process. Now, a good thing to note is that we are not looking at the different costs of labor resources, so it's reasonable to assume that the managers would be more costly resources than the AP analysts, but we don't get into that within this model. Once we've obtained any necessary management approvals for the invoice batches, we'll be ready to pay the vendors. And the way the company currently does business, it uses pre-numbered check stock, so there's a bit of time consumed by the AP analyst to process the payments in the system, print out the checks, and mail. So now we've walked all the way through the business process, and on average it takes 8.3 minutes of AP analyst time to process an invoice from a standard supplier, and on average it takes 9.9 minutes to process an invoice from a temporary supplier. So now that we've gone through step by step and calculated how long it takes to process a standard supplier AP invoice and a temporary supplier AP invoice, we can go back to our volumes of invoices by type, by location. and calculate on an annual basis how much AP processing time is consumed by the current flow of AP invoices on an annual basis. And when we go through the calculations, we can see that, rounding up, we consume something like 2.6 million minutes of AP accounting time per year to process the invoice flow. So making an assumption about the number of productive working days per year that our accounting staff have, that there are 240 working days after all the vacations and holidays, we can take the number of minutes consumed annually and we can come up with 22 full-time accounting employees needed to handle the AP invoice processing at the company. Now that we've built up a vanilla model, we're going to have a reality check where 3 of our operations don't have the same productivity level for processing AP invoices as the others. Of course, in reality, if you were going out to a large number of offices across the globe to look at how they handle one type of business transaction, you'd probably find a wide variety of processes and ways to get things done and productivity levels. In our model, we're going to focus on 3 locations that are out of step with the rest. So going back to our timings in the AP process, we find 2 steps where Chicago, Indianapolis, and Houston take much longer to accomplish the step than the rest of the world. And these are related to checking the purchasing system. So we're going to assume that most of the company uses one purchasing system, but perhaps due to some type of acquisition or other departmental decision, Chicago, Indianapolis, and Houston use a different purchasing system. And in this case, it seems to be not a great purchasing system because they take more time anytime they have to go over to that system, either to just check terms and compare to the invoices or to try to resolve an issue. The end result is that for these 3 locations, it takes quite a bit longer to process invoices. On average, it takes 18.5 minutes to process an AP invoice from a standard vendor and 20.7 minutes to process an AP invoice from a temporary vendor. Once we go back to the volume of invoices per site, we find that this adds up to quite a bit of additional processing time, and instead of 2.6 million minutes consumed per year of accounting staff time in the model now, we're consuming 3.4 million minutes per year, so it's quite a difference. Going back to the conversion to FTEs and assuming that there are 240 working days per year, we're now looking at 29 full-time accounting employees needed to deal with all of these AP invoices compared to 22. So at this point, let's assume that someone smart on the project team speaks up and says, wait a minute, you're assuming that 240 working days per year, but these are different facilities all around the world. They have different vacation policy, they have different federal holidays, so this assumption might not be accurate. So let's assume that we then go to our HR department and we ask them to give us some historical data on how many working days each of these offices have, perhaps over the last year, so that we have a point of reference. Once we've got the data on historical working days per year from HR, we can look at the volume of invoices per year from each location, and using a weighted average, we can come up with a more accurate number of working days per year, in this case 237 working days per year, which does impact the number of accounting FTEs needed. We're now up to 30 full-time accounting employees needed to address this volume of invoices. A reasonable question to ask at this point would be, why do we need a model to tell us this? We should be able to just take a head count of the AP staff we have at all the office locations. And there are really 2 answers that come to mind. The first is that the people at the various locations may have other jobs as well. They may not only do AP transactions. So we're actually trying to isolate the FTE equivalent of a particular work stream. And the second part of the answer to the question is, well, we also want to be able to have a predictive model. So instead of just doing a head count, if we build a model, we can change different parameters and see how that impacts the amount of labor that's consumed. Now that we've built up a model that we're reasonably comfortable with, let's try to estimate the productivity gains and future staffing levels we'll need after we go live with the shared service center. Remember that some of the governing assumptions were that prior to the shared service center, each office had its own way of processing invoices, and that the shared service center project would include moving to a unified global finance and accounting system. So in our model, we'll look at 4 different ways that this company ends up getting productivity gains from the shared service center project. The first is a consolidated view of supplier data, and this doesn't even necessarily mean renegotiating with suppliers, just having a more unified view of the supplier base. The second driver for productivity gains is AP automation, so using tools and technology to drive out some of the manual work associated with getting AP invoices into the system and processing them. The third driver is PO system standardization. In this case, we're not talking about necessarily improving business processes for purchasing or getting a new system for purchasing, just using the same one globally. And finally, we'll look at another source of productivity gains, which is using tools and technology to drive out some labor from cutting checks and sending them out to suppliers. Going back to the timings in our AP process, some percentage of the time we had to enter a new vendor in the system because they didn't already exist, and what we'll assume is that in the future state this doesn't happen as frequently because we've got a more global view of suppliers. Now, in order for this assumption to hold, we'd have to have a valid data conversion and cleansing strategy as part of the shared service center project. The second driver of productivity gains in our model is from employing AP automation, so basically tools and technology to help drive out some of the manual labor of getting invoices into a business application. And we're looking at a generic flow for how this works. The invoice is captured, meaning the data and the image, through a centralized scan location. The image and the data are then archived, and a user working within the business application can then access the invoice and process it and see the image in their system as well. So this is something that can be done with Oracle Web Center imaging or other tools that are out on the market. Going back to the timings in our model, we'll assume that the manual effort of getting the invoices into the system is reduced by quite a bit through this technology, and it's worth pointing out that the centralized location for scanning does not have to be the same location as the shared service center. If as part of the HR strategy we feel like it's advantageous to have that elsewhere. When we built up the model, we assumed that Chicago, Indianapolis, and Houston were not using the same purchasing system as the rest of the offices, and that this was a drag in their productivity. So we'll assume that as part of the shared service center initiative, Chicago, Indianapolis, and Houston are brought onto the same purchasing system, so their productivity levels come up to the same corporate average everyone else has. And of course, this doesn't really assume that we go through a wholesale business process reengineering, just that we get some people off a legacy system that may have been the result of some type of merger or acquisition. And the last driver for productivity gain that we'll look at is check print automation. So in the old way of doing things, the company was using pre-numbered check stock. They're now using technology to print checks as a batch. They may be using something like Oracle BI Publisher to burst the invoices. They'll be automatically numbered by the system, and this drives out a lot of labor at the check printing stage. So now our times for processing a standard supplier AP invoice went from 8.3 minutes per invoice down to 6.4, and for temporary suppliers from 9.9 minutes down to 7.6. And the point is, as we'll illustrate in the following slides, when you have a very large volume of transactions, small productivity gains and small timing improvements can generate a tremendous amount of business value. Here we'll look at the AP invoice processing volumes that we presented at the beginning of standing up the model, and with the new timings on standard supplier invoices and temporary supplier invoices, we're now projecting that we'll be consuming about 2 million minutes of AP processing time per year, down from 3.4 million minutes per year. As we convert the number of accounting minutes consumed per year to accounting FTE equivalents, we're projecting that after implementing the shared service center approach and the systems that support it, we'll move from 30 FTEs, or the equivalent of 30 accounting FTEs being consumed on an annual basis, to 17, and that's a 43% reduction in labor. And this is just a model, but this is within the range of gains that companies expect to get from shared service center initiatives focused on routine high-volume finance transactions. Just as a reminder, this is a simple model intended to illustrate some of the relevant concepts in productivity gains from shared service centers. We haven't incorporated any type of analysis of the cost of labor at different locations, and we have left out a whole host of local business process variations that we would find in reality. Now that we've taken a swag at defining the value we hope to get out of our shared service center, let's look at some of the practical considerations for staffing as we think about how to transition internal employees and how to hire on new folks to staff the shared service center. So, of course, we're trying to achieve productivity gains to demonstrate business value from our project, but we need to be mindful of our responsibility to the business to process invoices in a timely fashion. So what will happen if our staff doesn't ramp up as quickly as we thought? Do we have people in local offices we can fall back on? How do we want to group the transactions? Do we want AP people to also perform some other type of business transaction? And then in a lot of cases, we see that companies will employ a firm like IT Convergence to do a global design phase to start these projects. So we can really analyze what transactions should be in scope for the shared service center versus out of scope, and what are the local variations that are going to exist, even if the transactions are being processed centrally in the shared service center. Hopefully you find this model to be useful and it helps you think about some of the drivers for productivity in your own business, as well as some of the bottlenecks that are holding back productivity. But every situation is different, and consulting firms like IT Convergence help our customers to baseline the amount of effort it takes to process transactions and to design shared business processes across regions or across the globe. As mentioned earlier, this video is not being produced in isolation. We're having a whole series of webcasts about different topics that are relevant to shared service centers. If you visit our website, you can find a schedule of the webcasts, as well as other videos and blog entries that relate to the topic of shared service centers. Thank you for taking the time to view this video, and on behalf of IT Convergence, I hope you find it useful in your future business endeavors.